there is plenty of opportunity. There's going to be plenty of opportunity. It's something that we're watching, we're keeping an eye on, we're being patient, and it's ultimately how you come out on top and well ahead of the curve on this and win these market events. This is the Realize Your Wealth podcast by Aretec Wealth. We want you to be wealthy. We want you to feel wealthy. We want you to realize your wealth. All right, here we go. We're back. It is the Thursday before the long weekend, so we're in a shortened trading week. Little bit better week, still a bit mixed. Slow start on Monday to markets, and we had a couple pretty strong recovery days, which was good to see. Seems Thursday morning a little bit slower this morning with oil prices going back up and after the speech last night, but we'll get into all of that in a few minutes. But how you doing over there? What's going on? What's happening, Greg?
Yeah, we got the long weekend, fairly busy. My family, Sydney's family, I think we're also going to the aquarium. So we got a jam-packed weekend, but I'm sure probably not as busy as your weekend with all the kids.
Yeah, we got hockey, we got the cottage as well. So we got some hockey, some cottage. Heading back there. Finally got a little bit of a break. The hockey season's finally winding up. I think we got a couple more weeks of it, then we're back to normal, back to reality.
Oh no, that's good. So is this like winter hockey finishing up or spring ball hockey starting?
There's no ball hockey. We gotta figure out the spring sports still and figure that all out. But I'll keep you posted as we move through. But no, it's I think we'll be heading up north more and enjoying that a little bit as the weather gets nicer. But anyways, yeah, looking forward to getting into things. It's a little bit more positive out there. Obviously, still mixed with everything that's happening out there. But we have seen some signs of strength, some signs of recovery. If you looked at the email that I sent out a couple days ago, we're starting to see these signs potentially of a de-escalation, or at least the markets interpreting things as a de-escalation and starting to rally, which is good to see. We had a speech from Trump last night, which the markets haven't liked too much, and I think you got oil prices rallying about 10% this morning, which is putting at least some early pressure on markets, but still a very interesting dynamic out there and lots to unpack.
Yeah, and really what's happening, Will, it seems to be everything. The markets are basically very headline driven right now. To your point, Trump had a speech, markets didn't necessarily like it. You have oil, jumping, but it's just really off of the speech and not any concrete kind of fundamental or technical change or anything. But the one thing maybe just to kind of start off and give some perspective is that, yeah, March obviously off the highs, not a great month, but when we're looking at portfolios, when we're looking at performance, numbers are actually quite good given everything that's gone on this year, which is good to see.
Yeah, all things considered, I mean, we had a really hot start. I mean, obviously 2025 was a strong year, and then we had a really hot start to the year through January and February. I think most of our accounts and portfolios were up mid to high single digits at the end of February. So obviously a bit of a shock when we get that correction that happened in March. But then when we're looking at things this morning and after sort of the end of Q1, most portfolios are up sort of low single digits, maybe 2-3% or so in that range. So we're still holding up well, all things considered. If we look at Q1 in perspective and say, you know what, we're up 2-3%. That's actually not that bad compared to long-term averages. So at this point, yeah, it's not fun to be going through a correction, but the damage is relatively contained, so to speak.
Yeah, so one thing, Will, you sent out a good email that you touched on earlier, and you sent it out a couple days ago, I believe. And a lot of that we were talking about energy, and we mentioned it this morning, how energy prices are surging. But maybe kind of give us your perspective on that and why that might be an area where you want to proceed with caution.
Yeah, I mean, energy is basically going in the opposite direction of the rest of the market. So when you looked at March and year to date, energy stocks and oil prices are up. Oil prices are up 100% year to date. And so every time you hear about the conflict de-escalating, you've got oil prices, energy prices going down, and the rest of the market going up. Every time you hear about the conflict potentially escalating, which is how markets and investors interpreted the Trump speech last night. You've got oil and energy surging. Historically, oil and gas investments, they can definitely have a place in portfolios and they act as a diversifier. It's probably not your best sign or signal, or probably not the area you want leading the market. There's a few times, whether it was 2022 is the one in most recent memory, but even leading into 08, 09, where you had energy and oil and gas prices flying and surging. And eventually those come down and stabilize and normalize for a whole host of reasons. But the challenge right now is you've got the straight block still. You've got 20% of the world's oil supply is cut off. That's just putting pressure on oil prices. That changes things like inflation and interest rate expectations, which have jumped up. It disrupts supply chains, of course. It also changes some of the global growth expectations, because all these countries that rely on oil and gas from the Middle East are basically getting cut off. So there's all sorts of ripple effects the longer this goes, and it keeps putting pressure. So I do think oil and gas prices, you're likely going to see them elevated to a degree. They're not going to go back to where they were at the beginning of the year. I just have a tough time seeing them going to from $100 to $200 a barrel on oil here. I think we're going to have bigger problems if that's something that plays out and happens. So just somewhere, we're watching, we're monitoring. We've got pretty little bit of exposure through some of the positions and ETFs. We're certainly not overweight in oil and gas. It's actually something I think I said either last week or a couple weeks ago. Some of these defensive, either energy or defensive areas of the market have gotten really overbought and overextended, and in my view have gone too far, too fast on the back of this conflict. And for investors who have those, it's probably an area that you want to look at selling down and moving into some of the other pockets and areas of the market where you can take advantage and capitalize on what's going on. But very, very interesting market dynamic for sure, and it's changed a lot really just in the last month.
Yeah, and the challenge with energy as well is that, to your point, Will, right now it's acting as like a defensive piece of the portfolio, but it's actually or defensive piece of the market, shall I say? But it's actually a very, very volatile area of the market. So even though it's going up now, it could just as easily come back down. So with our process, we'd rather just kind of hold on to cash as our defensive piece as opposed to energy at this point.
Yeah, and we have elevated cash levels. So through March, where it made sense, we were raising cash and taking some profits and getting more defensive. So across the board in our tactical wealth portfolio, our managed strategy, we have elevated cash levels. And the reason for that, one, is to manage risk. We've obviously got more headwinds than tailwinds going on, at least in the last month or so out of market. So we want to manage risk. We want to protect and preserve capital within reason where it makes sense in the portfolios. But probably more importantly, that positions us to be opportunistic. And as we start to see names, sectors, positions get washed out and markets get washed out, we can actually be opportunistic and take advantage of that. And this is what I would remind investors, although these periods are not fun to be going through. Just look back in the last 5-10 years or so. Even I think a year ago today was the tariff liquidation day when that all started and the big board came out. That turned out to be an incredible opportunity where markets from the bottoming there went up 30-40%. I pointed out in the email earlier this week, think of 2022. I think that was a 50-60% rally off the bottoming that happened in 2022, which was inflation and interest rate and supply chain, COVID fallout. And then think of the COVID crash in March of 2020. That was more of a 100% upside. The other one, which is more recent memory is 2018 was another significant. That was again a Trump tariff interest rate driven event that went on for a couple months, but really accelerated in December of 2018 and bottomed on Christmas Eve. And the markets through 2019 had a massive rally that was 30-40%, something in that range. So these events, they eventually lead to markets getting sold off, washed out. There's a physics to the markets, a physics of the markets that happens where these areas, these positions that come down and get washed out and oversold, they eventually will rebound as more demand and investors come back in. I don't think we're quite there yet where we've seen a bottoming and this thing is over, but we're starting to see markets kind of bump up on those levels where maybe they're looking like they're a little bit oversold and washed out, and especially in certain areas overall.
Yeah, and to your point, we don't know if this will last, another week, a month, a year. No one really knows. But maybe just to put it in context, Will, with our portfolio and our process, what are we looking at? Because I think investors know we're not looking at the headlines. We're kind of looking deeper than the markets. What are we watching right now to help drive decisions?
Yeah, so we look at a lot of technical indicators, and they're indicators that are based on supply and demand. Think of it as one stock, one vote. So instead of just looking at the S&P 500 or the Nasdaq or the TSX and looking at what that headline index is doing, we want to see what the whole broader market is doing to get a better idea of how many stocks are bullish, how many stocks are bearish, when signals start to reverse, when things get washed out. So right now, I would say signals are washed out. Certainly not at levels that you saw, uh, say in April of 2025, or when you get these really extreme events, which in some respects is good because it means markets haven't been completely beat up at this point. At the same time, it also means there's room that this thing could go lower. I also think the general trend, and it's not to be negative, it's just to be realistic. The trend on the market right now is one that is a headwind. It's why we've got more defensive positions. It's not hard to see when you see just what's going on out there, price action, news flow, not a lot of positive news, but we've also seen these things really don't last. They don't last forever. Yes, there can be periods where this, like 2022 was one where it gets extended out, and there's a bottoming, there's a big rally, there's another bottoming that happens, there's a big rally, then another bottoming. So, but often, whether it was 2025, 2020, 2018, 3 out of the last 4 of these major market events pretty much were one sell-off and markets rally and pick up. So it's very difficult to say and really nail down whether this thing is going to be more extended or not. But that's why we watch, we manage, look at the technical indicators, manage to that when it comes to asset allocation, sector allocation, because one, it allows us to better manage risk and understand directionally where the risk is. And it also positions us to be able to take advantage of opportunity when things start looking washed out and we get some confirmation that things look like they're starting to move in the right direction.
So right now with our portfolio, what we talked about, we have heavier cash balances, but the piece that is invested for the most part, is that just more kind of the offensive pieces of the market for when this does snap back to make sure we're participating?
I mean, not entirely, but I would say it's a lot of the positions that have been working over the last year or two. So it's financials, it's industrials, it's technology, it's materials. So it's certainly our gold and gold equities that we still have. We still have a fair amount of technology, although we have lightened up on that a little bit. We've got a good amount of financials and banks and those sorts of areas, and then we're pretty broad based in the industrial. So what tends to lead the market, those names tend to resume when it comes to relative strength and technical analysis. So often, what we've seen in March, those names do get hit at least disproportionately a little bit harder because in that first wave of market movement, traders come in and immediately start selling down the stuff that has massive gains. You also get short sellers coming in, start pushing names down, but you start to get a bottoming eventually in this, and that first wave is usually people who have sold stuff short that was really overbought, overextended before. I would say the more normal investors or medium to longer term investors start to come in and take positions. But the stuff that has that elasticity to it tends to resume and come back. And even if you think of 2022, that was largely the case where the stuff that was leading into 2022, some of the technology, semiconductors, software, different areas like that got hit really, really hard in 2022, but it eventually provided incredible returns when it got washed out through the year and into the fall. So what tends to happen is the positions that were leaders going into this, they will get hit hard. Some hold up better than others, but then they also tend to resume that leadership and basically springboard and fire back. And they also tend to be the ones that you can look at and say, you know what, these are the most oversold, these are the most washed out. So when this thing rebounds, talking about those physics of the markets, it's not going to be energy, it's not going to be consumer staples, it's probably not going to be defensive healthcares or telcos or REITs. Some investors pile into that because they think, oh, this is a recession coming, this is it, it's over, that's where we have to hide out. Really what you want to buy are the more either cyclical or growth oriented names and high quality stuff, of course, but the stuff that has gotten washed out, beat up, and is going to have that rebound. We're not there yet, but that's what you want to watch for in terms of opportunity. It's not, you're not going and buying energy stocks or consumer staples or a lot of the defensive dividend type names on a discount here. It's going to be more some of the sectors we mentioned, some of the cyclical, some of the growth, tech, industrials, materials, financials, those areas that are going to present the best opportunities here.
Well, just going back to 2025, one of the positions that we bought coming out of Trump's tariff crash was SOX, was another good example where I think it doubled from where we bought it. It's obviously given a little bit of that back, but point is those are the types of stuff that we're looking for that are going to lead the market higher once this thing does turn.
Yeah, I think tech likely. I mean, there's obviously risk and AI risk, and semiconductors probably a little bit safer. If you look at a lot of the software names, those are really beat up from Microsoft down through the whole. I mean, even look at the whole FANG complex or Meg 7 complex, I guess is the better way to put it. But there's opportunities there. The financials, pretty much U.S. financials especially, those are very beat up. And then our gold and materials space, which is its own special class for Canadian investors. For us, that's been beat up as well, and I think there's opportunity and reasons. Gold is going to trade much more in line with interest rates and U.S. dollar expectations, as opposed to just being a pure hedge against geopolitical chaos, which we're seeing. So I think what you'll see is as energy prices come down, this conflict de-escalates, gold will resume that rally. So there is plenty of opportunity. There's going to be plenty of opportunity. It's something that we're watching, we're keeping an eye on, we're being patient, and it's ultimately how you come out on top and well ahead of the curve on this and win these market events. So that's really how we're looking at it. Not fun to be going through this, but that's what we're here for. We're managing this. We're actively navigating what's going on to manage the risks and to take advantage of opportunities. So that's what we're here for. But at the end of the day, we want you to be wealthy. We want you to feel wealthy. We want you to realize your wealth. So enjoy the long weekend, everyone. I don't know, Greg, if you're going to be putting on an Easter bunny costume.
I think he's too young for that. So I'm staying from that, but you're probably actually more likely to be doing that. So,
yeah. But everybody enjoy, and we'll be back with you next week.